Good evening, everyone. It's great to have you all here for today's session on navigating ESOP valuations. I am Dribjot and I am joined by my colleague, Ms. Rashita, and both of us will be guiding you through this webinar. I hope you are excited as I am because we have a lot of valuable insights to cover. So, our session today is structured around four key areas. First one is the understanding of ESOPs, wherein we'll start with the fundamentals, covering what ESOPs are, the importance of ESOP valuations, and their life cycle from grant to exercise. The second is data methodology and key assumption, wherein we will touch upon the data requirements, key assumptions, and key valuation methods such as Black-Scholes, binomial lattice method, and Monte Carlo simulation. We'll also touch upon the major crucial assumptions such as volatility and expected term to expiry. The third one is expense recognition. Here, we will look at how ESOPs impact the financial statements, including the income statement charge, and we'll also look at the journal entries and as an example of expense recognition. The fourth one, the last one, will be the reporting consideration and audit checklist, wherein we'll talk about disclosure requirements, common audit concerns, and best practices for ESOP reporting to ensure compliance. I'm confident by the end of this session, you will have a clear understanding of how ESOP valuations work and how they impact the financial reporting. All right, let's get started. The first one, understanding of ESOPs. So let's start with the basic. What exactly are ESOPs? In simple terms, ESOPs and other share-based payment plans are a way for companies to reward employees by giving them a stake in the business. It's like a win-win situation for everyone. Employees feel more invested in the company's success, and the company benefit from more engaged and motivated workforce. Many competitors do offer equities based compensation to their workforce to remain competitive. From a financial perspective, these plans need to be accounted for properly. That's where IFRS 2, Ind AS 102, and guidance note on share-based payments 2020 comes in. In India, the share-based payment plans have become increasingly popular, particularly in the startup ecosystem and IT sector. Companies are using these plans to attract and retain top talent while conserving cash flows. There are mainly two broad categories of share-based payment plans. The first one is the equity settled, wherein we have ESOPs, which allow employees to purchase company shares at a predetermined price after a vesting period. Second is the RSUs, which are same as ESOPs, but employees don't have to pay any exercise price. That is and they receive the shares outright once vested. The third one is the ESPPs, which allow employees to buy company shares, often at a discount, through payroll deductions over a specific period. Although ESPPs are not widely used in India as compared to the other types of plans. Now, under cash settled plan, we have SARs, which provide employees with cash equivalent to the appreciation in the company's stock value over a predetermined period. These are commonly used by unlisted companies to avoid dilution while still offering performance-based rewards. Cash settled RSU are similar to RSUs for equity settled, except instead of receiving shares, employee receive cash equivalent to the share price at the time of vesting. Now, each of these plans come with its own accounting and valuation challenges. In this session, however, we'll be majorly exploring the accounting and valuation aspects with respect to ESOPs. Now, why is there so much buzz around ESOPs lately? Well, one of the big reasons is the regulatory compliance. That includes your SEBI regulations for listed companies, Companies Act provisions for unlisted ones, and disclosure requirements as per India's 102, IFRS 2, and guidance note. An interesting point to be noted here is that under India's 102 and IFRS 2, expense recognition is based on the fair value approach. wherein under guidance note, the company can choose between intrinsic value or fair value approach. However, they would still need to prepare disclosures on fair value basis. Beyond compliance, ESOPs also play a crucial role in informed business decisions. It impacts the company's financials. So understanding how they affect P&L P&L, balance sheet provisioning, and dilution is crucial for leadership. Now that we have understand the significance of ESOPs, let's take a look at their life cycle. Let's take a closer look at how ESOP progresses mainly from grant to exercise and what happens at each stage. The first stage is granting of options. This is where the journey begins. The company grants stock option to the employees, but handling them out isn't enough. There's a structured approach to determine their fair value. Companies use valuation models such as Black-Scholes option pricing model, binomial lattice model, and Monte Carlo simulation model to price these options accurately. Various assumptions comes into play, including share price, exercise price, volatility, expected term, dividend yield, and the risk-free rate. The fair value of these options is calculated on the grant date, and this value sets the foundation of how expenses are recognized in financial statements. So now that the employees have been granted options. Now what next? Let's look at the vesting. The vesting period is where things get interesting. Employees don't own the options outright just yet. They need to meet specific conditions such as tenure or performance matrices before they gain the right to exercise them. The fair value determined at the grant date is spread over the vesting period, ensuring expenses are recognized gradually rather than all at once. Certain assumptions like attrition rate or any non-performance or non-market based performance conditions impact the number of ESOPs expected to vest. For example, if a company expects 10% of employees to leave before vesting, the assumption that assumption is factored in while calculating the expenses. If any lapsation, modification, cancellation, or settlements occur during the vesting period, and these are for lapsation, modification, cancellation, and settlements of the options occur during the vesting period, adjustments are made to the P&L charge accordingly. Now, once employee have completed the vesting condition, they have fulfilled all the conditions, they now have the right to exercise the options. At this stage, the third stage, employee can finally purchase the share at a predetermined exercise price. However, a few key things to note here is the fair value of the option is determined at the grant date. And unlike cash settled instruments, there's no remeasurement at this time of exercise, unless any modification or to the ESOP scheme have been made. If the employee decide not to exercise and lets the option lapse, the expense that were previously recognized will not be reversed. It will remain part of the equity and it will not be reversed through the income statement. And that completes the ESOP life cycle. Understanding these stages is crucial to valuing ESOPs accurately and ensuring proper financial reporting.